Week that was dominated by escalating U.S.-China trade tensions. And then it seemed they were friends, then they weren't such friends. And then the bond market got us worrying about a recession. So what do? Let's get some advice on building a defensive portfolio amid all this volatility. We're joined now by Jay Bala, Senior Portfolio Manager at AIP Asset Management. Good to see you, Jay.
Hey, thanks for having me on.
So this is definitely the kind of week where when you see this kind of action, these wild swings from day to day, people are really thinking about their portfolios and wondering, do I have the right mix here? Have I gotten defensive enough?
Yeah, well, I think this is the key problem with most people. It's when the market tanks, people stop looking at their portfolios, right? I always notice that. Like when the market's up, everybody's looking at their portfolios and things are going great. And then the market tanks and people just stop looking at it, right? Which is the scariest thing to do. And we always say, this is one of those pivotal moments in time where you need to go sit down with your financial advisor or portfolio manager or whoever you work with and say, okay, look, let's take a look at my portfolio. Chances are, we've had this great run in equities. I'm probably significantly over my threshold on equities. And let's have a realistic discussion about fixed income, right? We're modeling out a portfolio that says I'm going to generate 6 to 7% returns per year for the next 10 years. Is that realistic anymore, given that bond rates are now at 1.5%, right? And what I'm saying is, look, if you look forward 5 years, and I think we're in a low interest rate environment for the next 5 years. I think that's just the way it's going to go. And equities, you've got more downside risk than upside risk, right? That's reality.
The fact that we have pulled back this dramatically, but we're pulling back from record highs despite all of the geopolitical friction, the trade friction. We saw the markets in the States move to these new highs before all this.
Exactly. And I think the scary part that people haven't figured out is it's how fast and how intense that selling pressure is, right? Back in the day, we're not talking about 800-point decline over 3 or 4 days. We're talking about it swings that much in a given day, right? And so, I think people have to start looking at it and say, look, the public markets have been great for the past 10 years, whether you invest in bonds or equities or whatever it is, but start looking somewhere else for your diversification, right? At the end of the day, you want low volatility ETFs, and you want to start looking at things like private debt, private equity, and you want to sort of increase your allocation to alternatives, because I think the net returns over the next 5 to 10 years is going to come from alternatives rather than the public markets.
The private equity thing catches my attention because, of course, for a while there, when the discussion was about how expensive everything was getting, you say, well, what's out there for the private equity players to make a move on that's not going to cost them an arm and a leg? But things are changing, so you see some opportunity there.
Absolutely, and I see it in both private debt and private equity. And in private equity, look, there's always an industry that's going through a cycle. So, if you look at a private equity fund that buys, say, energy assets at this time, oil's relatively cheap, or resource stocks are relatively cheap, right? So those are things that they can buy. Of course, they can't buy the traditional manufacturing and stuff like that, but I think there's still solid returns that they can generate going forward. And I think there's sort of a decoupling in terms of sort of multiples, right? Now, because of the intensity of the amount of ETFs that are in the market, I think 80% of all trading volume is now passive. It's either high frequency or it's ETF money. So if you're linked to an index, like TSX 60, you're going to have a significantly higher multiple than someone that is not linked to an index, right? And I think you've seen it in the latest one where Onyx bought out WestJet. It was cheaper to buy a public company than to go out and buy a private company, right? So, and there's sort of that mass decoupling. So, I think what people really want to focus on is, how do I build a portfolio that's going to lower my volatility and over the next 5 years generate additional income, right? And I think
in a low rate environment, I want to ask you then, because people will automatically think utilities and real estate, because obviously a lot of their obligations are in debt, and the lower yields often move money into that sector. Is that model still true?
Yeah. I think going forward, even for our SMA clients, what we've done is we've reallocated from just conventional equities to low volatility ETFs. We think those are going to do much better, and those guys are obviously higher weighting in real estate, utilities, consumer staples. And the private debt market we like because that's a relatively new market, right? If you look at sort of a Canada Pension Plan or Ontario Teachers, their allocation to these kind of products has been around for the last 10, 15 years. And if you look at their allocation to just the alternative category, it's grown from 10% to 30% now, right? And their returns have been good. And what we like about the private debt space is that it is a relatively new segment of the market that's coming to regular clients. I mean, usually like just pension funds bought into private debt.
They had to be a pretty sophisticated investor, institutional investor, to get into that kind of space.
Right.
So there is opportunity now for the likes of you.
There is. Yeah, and I think the company that's done it really well and invested a lot of money into building out that space is a company called 9 Point Partners, which was the old Sprott Asset Management. I mean, they've got a great deck of funds, they've got a great suite of portfolio managers, and they've really brought in the right people to build out that strategy well. And if you take a look at their fund performance, it's nice, stable, steady income, right? Like, they're generating, call it 6 to 12% returns, and it's steady returns. And then, of course, the key difference in all of this is there's a lack of liquidity in private loans, right? So, I mean, these are senior secured loans. You're lending it against assets of a company, so you secure it that way. But on the flip side, there is no secondary market. And so what you're getting is that sort of liquidity alpha, right? Like if there was a secondary market, those spreads would come down and you would trade somewhere close to a high yield bond. So you might get like 4 or 5%.
So there's the trade-off right there. You want that return for your portfolio. There are some trade-offs that you need to be aware of.
Right. And what we're saying is, look, I mean, we're not saying, sell all your public equities and public bonds. What we're saying is allocate, right? Which means, like, let's say traditionally you're 50-50 equities and bonds. You might want to do, 40% equities, 10% private equity, and then 40% bonds, 10% private debt. And all that will do is enhance your yield on the debt side, and then it will give you a little bit more stability on the equity side. But the beauty of it, once we modeled it all out, is the volatility actually comes down quite drastically.
And then times like this, I mean, the week that we had right now, I guess we have no guarantee that we're not going to see another week just like it next week, because when we have markets moving on tweets, we never know what the next tweet's going to be, right?
And the reality is, look, the volatility is here to stay. It's not going to go anywhere, right? And, my view on the China trade tensions, the China trade war, is, I always say, look, at the end of the day, there may be a short-term resolution to this in the next few months because they need to do a deal. But this is not a short-term deal. This is a 20, 30-year problem, right? Like, at the end of the day, China has become a very large economy.
Powerful enough to get the Americans greatly unnerved.
Right. And at the end of the day, I mean, look, they've got things that they can use but haven't used it, right? I mean, for example, you saw the market come down 800 points. And all they did was make a minor change to their exchange rate, right? They dropped it from 7 to like 6.9. And that was enough, right? And that was sort of the shot across the bow to say, hey, listen, we've got other weapons that we could use. We're just not using them, right? That was a very clear message, right?
Interesting times indeed. Thanks for joining us, Jay.
Thank you.
All right, that was Jay Bala, Senior Portfolio Manager at AIP Asset Management.